Okay, so this will be our final video about CCA, where I talk about straight line classes and a couple of other miscellaneous things that we want to note, particularly the planning for CCA. All right, so one of the things I want to talk about is some special rules for luxury autos. So we have cars, automobiles are basically in class 10. All right, so normal automobiles stay in class 10, etc. But the government said, wait a second, some of these executives have the company buy very expensive cars. Maybe they're buying them a Lamborghini that costs $150,000. So there is a special class for what's known as luxury cars or luxury autos. And so that's class 10.1. Now, the first thing is that class 10.1 is for individual assets. So this one won't have an averaging. It'll be more like the accounting. It's separate 10.1 classes for each individual car that would be excessive. So, and the amount that you can deduct, amount available for CCA is limited. And they change this number regularly. You might want to make a note in your act that currently that amount is $30,000. Now, that would be 30,000 plus HST, GST, but in some cases. But if you'll look at this, we'll talk about this when we look at the HST, GST rules. If the owner is a registrant, you don't add the HST or GST. And 99% of the time, the owner is going to be a registrant. So for the most part, we aren't going to worry about that. You would note that if it's PST, provincial sales tax, you add in all cases. So you should note that, but we aren't going to worry about it, and I'm not going to worry about it on exams or anything like that. So we want to add to the class maximum CCA available is the 30,000. Now that then is fine, and then you do the normal rules. You've got class 10.1, you would add the 30, you add the 1/2 net, that doesn't go away. So in the first year, you're going to take 30%. It's a 30% class still, so you would take 13.5 would be CCA, all right, year one. So we'd have our class 10.1 with 30,000 minus CCA. So we would have a UCC balance of 16.5. Now, what you want to understand is in the year of sale. In the year of sale, there is no recapture, no terminal loss. The problem here is that maybe I paid, like I say, $120,000 for that car. All right. Well, if I sell it for 80, yes, I mean, I used up 40, but I'm not allowed to take CCA for that much. All right. And conversely, if I sold it for 150, I'll still have a capital gain. If you sell for 150, you will have a capital gain of 30. But again, I can't adjust CCA because I only put 30 in the UCC account to start with. So what you do in the year of sale is you simply take 1/2 normal CCA. So I would have CCA in the year of sale on this situation of 49.50 times 1/2. I would take CCA of 24.75, and then you just get rid of the account. There is no recapture, no terminal loss on this class of assets. So that's the auto rules. Now there's Other special rules I've got, like slide 10, you can look at under the CCA for electronic office equipment. Certain equipment can be put in a separate class 8, which allows the possibility of a terminal loss more quickly. Manufacturing and processing equipment, class 53, is basically 100% now. The reason it's 100% is class 53 is a 50% class, but we've got that 1/2 net rule, so it winds up being 100% because you take 50% of the 100. So you wind up with the year one, the class 53 manufacturing equipment is 100% write-off. Now, intangible, unlimited life. So you've got two types of intangibles. You've got limited life intangibles. And that's a straight line calculation over the number of months. So you literally, like if you've got a 10-year license, 10 years, so 365, sorry, 12 times 10. No, it's number of days. I apologize. It's number of days. All right, so 365 times 10, 365 times 10 is 3,650. And the number of days you used it in the year. If it's the full year, it's 365 divided by 360, etc. So it's just your basic straight line. Now, what you do, I will say, is with the straight line classes. So if I have say a 10-year license that I purchase, and maybe I purchase it on, let's do February 1st. So it's 365 days minus 31. That's 334 days that I've used it if I have a calendar year company. So let's say the cost was 12,000. All right, I multiply that times 364, or sorry, 334 divided by 3650, the total number of days. And that is 1,098. Now I multiply that by 1.5, which is 1647 CCA for the first year. So with the straight line classes, you don't do a 1/2 net thing. You just calculate the first year CCA and multiply it by 1.5. So if you have a limited life intangible, straight line, number of days, and the first year 1.5 to get the accelerated CCA. For unlimited life, so unlimited life intangibles, goodwill, customer list, things of that nature, that's a declining balance class, and it's done exactly the same as all the declining balance classes that we talked about. It's class 14.1 and it's a 5% class. So all your unlimited life intangibles go into the class 14.1 and then do what we demonstrated in the CCA lecture number 2 with the mechanics. Now, some cost adjustments. If you look at slide 12, I believe it is, in the CCA, the interest, things of that nature. It depends on the situation. It pretty much follows accounting rules. During construction, interest is part of the cost of the asset. Things like grants and things of that will decrease the cost of the asset. So there's a couple of adjustments that you make there that you can note. I've noted on slide 12. Then straight line classes in general, we mentioned class 14. The other one is class 13, the other major straight line class, and that's for leasehold improvements. So if a company leases an asset, typically this would be related to a building, Okay. This will be straight line, a straight line calculation. So the company leases the building and they might, put up walls or whatever, petitions to divide it up the way they want. Now this one is a lesser of calculation. So we have the lesser of, the maximum is 20% a year. So the lesser of is the cost times, or sorry, divided by 5. Okay, that's your 20%. So the cost divided by 5, whatever. So let's do leasehold improvements of 30,000. So that would be 30,000 divided by 5 is 6,000, would be our CCA for year 1 and then every year thereafter. And again, if that's it, you'd multiply by 1.5. Again, it's straight line class, as I mentioned, with class 14 to get your accelerated CCA. The other calculation would be the cost divided by the lease term plus 1 renewal. So if the lease term is, say, 6 years and you have the right to renew twice, one for 3 years plus 2 years, I would take the 6 plus the 3. So that would be 9 years, and I would take the 30,000 divided by, sorry, my mind just went blank, divided by 9. And that would be 3,333. So clearly that is lesser. So I would do the lesser of times 1.5. And that's 5. I would ignore this second one. So it's the lease term plus 1 renewal and the lesser of those two. Now, I want you to understand, for my purposes, like sometimes this is obvious. If I know 6 plus 3 is 9, why would I bother doing that? And that's fine. Except for my purposes, for exams, you have to show me both. If I ask you to do CCA that involves a leasehold improvements, you have to show me both. Part of that is to protect you. If you make a mistake in one of these, you can wind up where it should have been using this one and you use this one instead, or vice versa. I need to see that you understand that it's a lesser of, and the way you demonstrate that is you show me all the calculations. So if you look at old questions, old midterms, old quizzes and whatnot, it'll always say show all calculations regardless of whether needed. That's the sort of thing I'm talking about. Now, I also want to point out, if you do leasehold improvements after the start of the lease, so maybe we have the original lease, 6 years plus the 3, and then 2 years later you do some more improvements. Then you have, it would be 4 years plus the 3. So if you start improving as time goes on, you would drop that lease term number. Okay, now we have other things, and these slides talk about involuntary dispositions and insurance proceeds. I mentioned change in use, that it's treated as a disposition. You can look at those slides. I'm not going to talk about those in detail. Those are the advanced level that you're not actually responsible for in any detail. So I don't have anything to go over with those with you. I do want to talk with you briefly about the planning. Clearly, CCA impacts the decision of purchasing long-lived assets. CCA essentially deductions decrease the tax due in any given year. That decrease is called the tax shield. the amount that the CCA deduction saves tax, that means you're saving cash. It's a cash flow issue. So we want to be able to, when we make our decisions, have an estimate of that tax savings that we're going to have, that tax shield, so that when we make our acquisition decisions, they're done on an after-tax basis. Remember I said way back when, everything has to be after tax. So the formula is on the slides, the formula is in your textbook that you apply. It's a formula of the estimate. Obviously, CCA is an estimate, so it's not exact, but when you think about it, we're talking about your capital budgeting decisions. And in your capital budgeting decision, you have to estimate revenues as well over a time period that you would use the asset. Well, that's not exact either. So the fact that the CCA tax shield calculation isn't exactly correct, it deals with an estimate, that is consistent with the fact the whole thing is an estimate. So you want to be very sure that you understand how to do that tax shield. Now, that particular formula, go ahead and put it in your act. You don't have to memorize that formula. I don't expect you to memorize that formula. So you can go ahead, put that in your act. If I ask you questions, use it. Okay. Now, just in terms of helpful things, I thought I would note for you that you can go online, and if it helps, go and get Schedule 8, all right, for the capital cost allowance. This is for our current rules. You can see it's a T2, Schedule 8, right? So this might be helpful to you. The other thing I want you to be aware of is in your Income Tax Act, at the beginning of the act, find this, right? You will find an alphabetical list of assets with capital cost allowance, CCA, classes, and rates. I expect you to be able to use this. So for testing purposes, I will use anything that's in here. And let's see, let's try to get this focused in even further. Come on, there we go. All right, so I might, ask about asphalt services in a storage yard, airplane runways. I mean, I could give you any of this because I expect you to use it and be able to use it and find any given asset. I will not ask you to do CCA on an asset that isn't included in this list. So make sure you find it in your act, and it's got several pages to it. But what I want you also to note is on the first page, for example, I've noted, let's see, that goes back to, yes, okay, we want to go back here. It's kind of dumb. So at the bottom of the first page, it says buildings. And then the second column, it has a whole bunch of building parts or types of buildings. All right. So if we get to manufacturing building, non-residential building, note footnote 39. So make sure you've also looked at the footnotes. When we go to the footnotes, footnote 39 talks about additional allowances that are available. So the basic rate for class 1, this is what buildings are in, is 4%. But if we have a manufacturing building, 90% used for manufacturing, we get to add an extra 6%. So in fact, the CCA rate for a building used to manufacture or process is 10%, not 4. And if we have a building that's used for other non-residential purposes, maybe a warehouse, something of that nature, we have a 6% rate, the original 4% for class 1 plus the 2%. So you do need to pay attention to the footnotes in those pages in the front, as well as paying attention to the actual classes that each individual asset might be in. So make sure you find that, tab it, and get comfortable with it while you're doing your assignments. And then you should be okay with the problems that you would have on any testing situation. Again, any issues with this, get a hold of me. Okay.